Hi everyone, Jeffrey Haig here again, and this video is going to look at Chapter 6, which is our individual deductions. If you recall from Chapter 5, we were looking at what was included in income, in gross income, what we realized, what we had to recognize on the tax return. And remember, the concept is that all income is includable unless there's something specific that tells us that it isn't includable. For Chapter 6, we talk about individual deductions. And unless something specifically written in the law, in the code, nothing is deductible except for when it specifically tells us that it is. In this chapter, we look at individual deductions. We look at some personal deductions, such as medical expenditures, charitable contributions, interest expense, expenses related to being an employee. Also, we look at some business deductions and also some rental deductions. So before you continue watching this little video, I suggest that you print out the following forms. You'll already have your 1040 printed out from last time, Form 1040. You should also have printed out Schedule A, Schedule C, and Schedule E. We spend a lot of time on Schedule A. We talk a little bit about Schedule C, which is for a small business, and a little bit about Schedule E, which is for someone who has rental property, like a house they rent out. Schedule A, for itemized deductions, is what we'll spend most of our time on. This chapter has 3 learning objectives. The first one is looking at deductions for AGI on the front page of the 1040. This includes looking at Schedule C for a small business and Schedule E for rental property. That's learning objective 1. Learning objective 2 spends the time on Schedule A, which is itemized deductions, which are a lot of personal deductions that are allowed on this form. Learning objective 3 looks at what we call the standard deduction. If someone doesn't have enough items to itemize or take the itemized deduction amount, they're allowed to take the standard deduction amount. And the taxpayer or the computer program will look at the standard deduction and compare it to the itemized deduction amount, and whichever amount is larger, that amount will be taken from AGI to reduce taxable income. All right. Once again, as if with all chapters, read your learning objectives or the summary on page 39 of the chapter. Read the conclusion paragraph on page 38. Do that, skim the chapter, look at the homework problems, look at what forms we're looking at, make sure you have those printed out, and then read the chapter. So let's look at the chapter together. Learning objective 1. Like I mentioned already, learning objective 1 starts looking at my deductions for AGI. We want to get our adjusted gross income, or AGI, as low as possible. That's the goal. All within the law, of course, but as low as possible, because having a lower adjusted gross income will allow us to take higher deductions on Schedule A, which we'll see when we get to learning objective 2. So learning objective 1. This covers a lot of business activities, deductions for business activities. Think of a taxpayer as being able to have 2 types of jobs. A taxpayer can be a W-2 employee, be an employee for someone, and a taxpayer can also have a small business, or a taxpayer may just have one or the other, but some taxpayers have both. So having a business, those deductions will be reported on Schedule C for a small business. And they show Schedule C on page 6-4. and you'll have a Schedule C printed out when you're reading this chapter. We'll go over this more in a future chapter, but here they're talking about what deductions are related to business which can be taken. Notice on page 6-4 the two words or the three words in bold: ordinary and necessary. Whatever is ordinary and necessary for a business can be deducted on this Schedule C. So Schedule C has a lot of deductions here. They have these expenses line items, basically 8 through 27B. 27B is all other deductions that aren't specifically listed on this form. So a lot of these expenses are what we've seen in bookkeeping or what we've seen in accounting, or expenses you would think that would be related to a business. As long as they're ordinary and necessary, they can be reported here. Page 6-5 talks a little bit about Schedule E, which is for rental property. Someone who has a house, rents out a house, they would report it on Schedule E. So they have some expenses that they list on that schedule. And once again, as long as they're ordinary and necessary for a rental property, for a rental business, they'll be reported on Schedule E. Now, Schedule E is just for renting real property, like a building or a house. If someone rents go-karts or someone rents trucks to take through Joshua Tree, Jeeps, that will be reported on Schedule C. Schedule E is for real property, like a house or a building that's rented out. If that person rents out washing machines, or like I said, Jeeps or cars, it'll go on Schedule C. Now, 6-6 looks at deductions indirectly related to business activities. You see in these two pages, 6-7, that they talk about moving expenses. Only moving expenses are only deductible if the taxpayer moves because of a new job. It can be with the same employer, but if it's a new job, a new location, 50 miles further than where they are now, in most cases, it can be deductible, those moving expenses. 6-8, health insurance deduction for self-employed people. If someone's self-employed or has their own business and they pay their own health insurance, that can be the deduction for AGI. 6-9, self-employment tax deduction. Someone who's self-employed has to pay both the employee share of self-employment tax, and the employer share of the self-employment tax. They have to pay both sides. When you're a W-2 employee, the employer pays some of the Social Security tax and the employee pays some of the Social Security tax. When you're self-employed, you pay both sides or both amounts of that Social Security tax. You get a deduction for taking or for paying some of that tax, and that's on page 6-9. Also on page 6-9, penalty for early withdrawal of savings. If you take a savings account out if you close out a certificate of deposit or a savings account early and there's a penalty for taking the money out, you can deduct that penalty for AGI on the front page of your 1040. Then at the bottom of 6-9, they talk about deductions subsidizing specific activities. I don't know why they use the word subsidizing. Basically, it's kind of like saying that it's helping you pay for these activities. And the main activities they're looking at here are educational expenses. Some cases you can deduct the amount you paid for a class in college. In some cases you can deduct the amount of the student loan interest you have if you took out a student loan to help you pay for those courses. And they go through a couple examples on this on page 10 and page 11. Page 10 is talking about the deductions for the interest on a qualified loan for educational purposes. And then page 11 is when they're talking about taking the actual amount of the expenses for some college courses you've taken. You can deduct that for AGI. Page 12 and page 13 is like summarizing what we talked about in those last few pages, and they give a good example on Exhibit 6-8, looking at my my Form 1040 here. And you can see some of these line items we've talked about. Line 26, moving expenses. You need to attach a form for that. Line 27, deduction for part of your self-employment tax. So looking at this individual, Courtney, she's not only moved for work, she also is self-employed, so she can take some of her self-employment income tax she pays as a deduction for AGI. Penalty on early withdrawal for savings, line 30. And student loan interest, line 33. Take that. Tuition and fees, line 34. So if something qualifies for as a college course, they can take that as a deduction for AGI. So to give good examples here, also as you see, Courtney does have a business. If you look on page 12, she has some business income. And related to that business income, she's also paying self-employment tax. So she gets a partial deduction for that, once again, on line 27 down below. Let's see. Line 11, she gets some alimony from an ex-spouse. So she has that as income. And if you look on line 17, she has rental real estate, meaning she has a rental property that she's renting out, and she has income there of $3,000 on that property. So look at that Exhibit 6-8. It kind of sums up what we talked about in the last few pages. Learning Objective 2. Deductions from AGI. The second page of the 1040, Schedule A, being attached to the Form 1040, is my itemized deductions. Looking on this form, most of these things are personal items. Some are related to being an employee, some are related to having investments, but most of these are personal activities, which we'll talk about starting on page 13. The bottom of page 13, they talk about medical expenses. Okay, so they go through a lot of examples on this, page 14, page 15, okay, medical expenses. And here, if you look on Schedule A, you'll see that there's a limitation of how much medical expenses you can take. Your medical expenses for a taxpayer has to be over 10% of their adjusted gross income. That means if someone has adjusted gross income of $100,000, 10% of that, which is $10,000, someone will have to have more than $10,000 of medical expenses to be able to deduct anything. So, if someone has AGI of $100,000, 10% of that is $10,000, and if they have $12,000 worth of medical expenses, they're able to deduct the difference between $12,000 and $10,000, $2,000. So $2,000 can be deducted as medical expenses. Even though they had $12,000 in total, because of the adjusted gross income percentage limitation, they can only take $2,000 as a deduction. So you can see that's why we want to get our AGI as low as possible. Because if we were able to get their adjusted gross income from $100,000 down to $80,000, then 10% of $80,000 would be $8,000, $12,000, all their medical expenses, less $8,000, the percentage limitation, would mean that they could deduct $4,000 of medical expenses. So once again, I can't emphasize this enough. Getting adjusted gross income as low as possible is the goal, as long as we're doing it legally and ethically, to help us take more on Schedule A for personal expenses. Page 16, Taxes. This is another deduction on Schedule A, and this is from lines 5 through 8 on Schedule A. Most of this is like income taxes. People in California and New York and Illinois, they pay a lot of personal income tax because we're high tax states. Illinois, New York, California, Connecticut, high tax states. We can deduct our state income tax. Also our property taxes can be deducted here, and certain fees paid to the DMV, usually based on value. Not the whole DMV fee, but only the part of that DMV fee which is related to the value of the vehicle can be deducted. Interest, page 17 to 18. Page 18 gives some examples of interest. This interest is mortgage interest, interest on a principal residence, and a second home. So someone can have two homes. The home they live in, which would be the principal residence, the one they spend their most time in, and then they can also have a second home, and any mortgage interest on that can be deducted. We'll look at more of the interest stuff in a future chapter. Chapter 7, they go into that a lot to talk about home ownership. So we'll look at that more in a future chapter. Charitable contributions, page 18 to page 19. They talk about giving money to a charity, and then they talk about giving property to a charity. If you give money to a homeless person or a person directly, someone who's been in trouble, or say they went through a bad situation like a fire destroyed their house, if you give money to an individual directly, that can't be deducted. It has to go to a charitable contribution. So that's why when you hear when someone gets into trouble or they set up an educational fund for someone, that means you give it to that fund or to the bank to help disperse that money, because you're giving it not directly to the person but to the charity or the organization that will then give it to the person. So money's talked about. Contributions other than money, such as we give clothing or give assets, they talk about that on page 20 to page 21. You cannot deduct your time. People have asked me, well, I spent 10 hours at the food shelter or the homeless shelter. Can I deduct, $100 of my time? No, you can't. You can deduct the mileage that you spend going to help at a charity. So that is deductible. Same with the mileage for going to the doctor or going to the dentist. Those miles are deductible also. On page 21 to page 23, they talk about the limitations. You can just skip that. It's just basically saying that if someone gives a lot more than their adjusted gross income is, there's limitations on how much they can deduct as a charity. And whatever's limited can be carried forward in the future years and taken as a deduction in those years. I've only seen it happen a couple times. This one woman I do her taxes for, she makes like, $20,000 from her investments. She gives like $15,000 every year. So she can only really deduct $10,000 of that charity deduction, and the rest gets carried forward to the next year. She keeps telling me she's going to reduce how much she gives to charity, but she never does. So she always has a big carryover because she's giving much more than her adjusted gross income is. Start again on the bottom of page 23. Okay, start reading there about casualty losses. And they talk about casualty losses. It has to be a sudden event, like a flood or a fire. It can't be like a slow event, like termites or mold. Some cases they say that's okay, but usually it has to be suddenly and quick. You had no chance to prepare for it. So that's a casualty. The other one they talk about here is a theft. Someone steals something, you can deduct that. Of course, there's limitations. Once again, adjusted gross income plays into this, how much I can deduct. But a theft, when you discover it, that's when you report it. So if someone stole something from you years ago and you didn't know about it until this year, you deduct it on this year's tax return. And of course, if you find it later or get an insurance reimbursement, you'll have to report that reimbursement in the next year. So they give an example on page 25 about different stories about, people's engagement rings, wedding rings, okay? Page 26, miscellaneous itemized deductions subject to basically 2% of my adjusted gross income. So once again, we want to get our AGI down as low as possible so I can take these deductions. And a lot of these deductions here are related to being an employee. You say, well, being an employee, why should I have any business expenses? Some employees or some employers require their employees to drive, for example, maybe work from home, maybe do some stuff that the employee has to pay for. If the employer reimburses that employee for whatever they spent, there's nothing to report in terms of income by the employee or an expense by the employee. Because an employer has a plan where the employee gets reimbursed for whatever they spend, then there's nothing to report or deduct. The employee's even. They haven't made any money, they haven't lost any money. But if the employee has to pay some stuff out of her pocket, she can report these expenses as employee business expenses. On page 27, they talk about commuting. So commuting back and forth to work is not a deduction. Even if it's a 2-hour train ride, and the employee said, well, during that 2 hours I spend on the train every morning, and the 2 hours I spend on the train every evening, I should be able to deduct that because I'm working. The IRS said, no, this is commuting, this is personal time. If someone has 2 jobs, and they go from the first job to the second job, that's deductible. But going home to the first job is personal. Going from the second job home is personal. That's not deductible. So they go through the commuting, meals and expenses like that. On page 28, they talk about when the employee gets reimbursed or the employee doesn't get reimbursed. So read those examples on page 28. They give good examples on example 27 is a good example. Bottom of page 28, investment expenses. If you're paying money to help investments, such as you have stocks or bonds, you can write off some of those deductions that are related to keeping those investments going. Tax preparation fees. If you pay someone to have your tax return prepared, you can deduct that fee. On page 29, they talk about hobby losses. So go through that and look on example 29. Okay, hobbies such as people who go to golf tournaments and play, bowling league tournaments, fishing tournaments. They go around the country thinking they'll win a little money here and there, but they're trying to deduct all these expenses as a business. The IRS says no. If you haven't made any income within 5 years of doing the activity, we're going to disallow all the expenses. So I've talked to a few people about that over my years of preparing tax returns, and they understand, and I tell them that the IRS is going to look at this and maybe deny it sometimes, so they know what they're getting themselves possibly into. Page 31, they talk about that 2% limit and how it works. And then also on page 31, they talk about some miscellaneous itemized deductions not subject to the AGI floor. Page 32, if my AGI is very high, and they give examples here on page 32, my itemized deductions start getting limited. Page 33 gives you a summary of what we've been going through with Courtney here. Good examples of everything, of what she's deducting. And then on page 34 is our last learning objective. Learning objective 3, the standard deduction or the itemized deduction. So a taxpayer gets their personal exemptions, which you talked about in the previous chapter. But here, learning objective 3 has to look at, do I take the standard deduction or the itemized deduction? Whichever one is greater, that's the one I'm going to take. Not everyone itemizes. Most people take the standard deduction. Itemized deductions are mainly for people who are in, like I said, high tax states, California, New York, Connecticut, Illinois, have a house, do a lot of charitable contributions. They'll take the itemized deductions. Other people would take the standard deduction. On Exhibit 6-11, they give you the standard deductions amount. Now, on page 36, they talk about some tax planning here. They talk about bunching my itemized deductions. Because I'm a cash basis taxpayer, most taxpayers are, most individuals are cash basis. When I pay something out, that becomes a deduction. So if I can plan to bunch my deductions, my itemized deductions, and they give an example here in example 34, if I can bunch my deductions in 1 year, maybe 1 year I can take the itemized deductions, which will be higher than my standard deduction, and then the next year take the standard deduction. And when you talk about bunching, that means I'm going to give a lot to, let's say bunching them, I'm going to give a lot to charity this year, and I'm going to pay my property taxes a few months before to get them into this year, so I can have a large level or large amount of itemized deductions. So I can take my itemized deductions, which will be higher than my standard deduction. And then next year, I'll just take the standard deduction. But then the next year, once again, I'll try to bunch my deductions up together, like give away to charity, give money to charity, medical bills, pay some medical bills up front or in a specific year, and then maybe pay my property taxes, more of them in 1 year. I'll have a large itemized deductions. So to give an example of this, okay? Then at the bottom of 36, they talk about your personal and dependency exemptions and how that works. And then on page 37, Exhibit 6-14, they're looking at that top of page 2 of the 1040, showing you the itemized deductions, which comes from Schedule A of $39,000 roughly, and then the exemptions, which Courtney has $12,000 in exemptions. And then the conclusion on page 6. Appendix A and Appendix B, read those. Those are just talking about the phase outs for itemized deductions and the phase out for the personal exemption, which means if you're at a very high adjusted gross income, roughly $300,000, $250,000 for single people. If you're at that level of adjusted gross income, your standard deductions, your itemized deductions get lowered and your personal exemptions get lowered. And they give examples of these on page 38 and 39. So I know I'm going almost to 28 minutes or a little bit over 28 minutes. I want to give you some key terms, which I want to make sure it's on the quiz next time. Casualty loss is good. Commuting, dependency exemption, hobby, miscellaneous itemized deductions, investment activities, ordinary and necessary. I always like saying those 3 words, ordinary and necessary. Personal exemption, standard deduction, and then trade or business. All right? And then remember to look at the educational expenses and educational interest on student loans. That's important to know also. All right? So I hope this helps you. And like I said, have those forms as we're talking. It makes it much easier. So I hope this lecture has helped you, and I will see you around. Bye.